Good morning, everybody. Welcome to the Trading Market Technicals morning call video for Friday, July 20th. Yesterday, we had our third straight session higher, and that's basically due to upbeat earnings results from Freeport-McMoRan, IBM, Qualcomm, and that's basically fueled the materials and technology sector to be the top performing sectors of the day. One thing that I wanted to point out, economic data that came out, Philly Fed, existing home sales, and initial jobless claims, weekly jobless claims, all did not meet expectations. So that's numbers that are continually deteriorating, which is a real big concern. You can't have a recovery if the economic data is not good. So that's something again that I wanted to point out to you. Another thing that's really that's a big concern of mine anyway is divergence between bond and equity markets. I pointed that out several times. I'm going to point it out again today with the yields and bonds and of course the S&P. And fixed income investors continue to put money to work, and they're basically long-term players. And where we have the S&P rallying higher, along with fixed income not really moving at all. So if the equity markets are rallying, we should not see bond markets just kind of have a steady track higher. So that's something that's a short-term catalyst. Is what I'm thinking is that once earnings season is over, I think you're gonna get back to the wall of worry, and people are going to start looking at the econ data again. So right now, they're kind of abating what's happening with the economic data and just looking into earnings, saying great. But you also have to realize a lot of the analysts have taken down numbers so dramatically. So is it really a beat? I usually tend to beg to differ. Anyway, last thing I want to talk about, we have no economic data coming out today, so it's all going to be about any earnings that are coming out, and as well as any news coming out of Europe, Greece. So that's going to be something that we need to talk about today. As well as Friday, it is a doldrums of the summer. I don't expect much to happen, and today is options expiration. Maybe get a small dip in the morning and probably rally into the close. That's usually how it works. Next week will be interesting, though. We are at an inflection point in the markets. I did mention at 1390, 1400. We're within 10 S&P points from there, and the market is building energy, and nobody really can decide where we're going from here. Are we gonna rally, or we're gonna break down? And the part that I mentioned yesterday, I'll show again on the charts, is that there's a thin zone above the 1390, and if we do break above 1390, there's plenty of stops that shorts are going to look to cover, which will squeeze the market much higher. Okay, so you really have to be on your toes and ready for that, because I would not want to be looking to short the market here until we get a signal. Momentum is definitely waning to the upside, no question about it. I'll show you with the indicators. So I wanted to make that a point. And I mentioned before, if you're a swing trader, I would definitely be looking to put hedges on if you're looking to ride out the storm. If not, then I'd be looking to tighten your stops, that's for sure. If you're day trading, it's a different story. All right, guys, let's roll right into the charts. As you can see here, 10-minute S&P, really not much what's happening. Now, if I just bring this back here, we were in a range here in the SPY for the last 10 trading sessions, and we did break out of it, right? So that fueled some more buying interest. So we actually rallied up here, we gapped up, and we're just kind of grinding higher now. And here, even on the 10-minute, you could see, we're just kind of creating this bearish rising wedge, and the wedge is only bearish until it breaks the lower trend line, right down here. So that's something that I want to just kind of show you, but I'll get into it more in a daily chart. Bar chart, momentum index, not really showing too much. As you can see here, we're stuck here in that 99, 100. Up in these areas here are way overbought, and down below are way oversold. So we're kind of stuck in the middle here. So not showing you much. But one thing I wanted to show you is the NYMO. And I didn't show this yesterday, but very, very reliable indicator. And as you overbought, way oversold. Here's what I wanted to point out. The NYMO actually ended up being down 479, right? S&P up. That's giving you confirmation that the momentum to the upside is waning. That doesn't tell you that it's overbought or oversold at this time. So it's just giving you a neutral reading, but it's definitely gauges momentum, and momentum is definitely waning. So that's something that's a real big concern to me as far as being a trader, day trader, or a swing trader. And here's this is something else I wanted to point out. This is the New York Stock Exchange Summation Index. This is a weekly chart. So really good 5-3 stochastics. Again, momentum. Kind of really pretty good picking up bottoms and tops, as you can see here. Bottom, top. And as you can look what's happening. We're starting to curl over now. This really doesn't go. You really want to take a look at this tomorrow. I'll put this on Monday just to show you how it turned out. Now, going into our indicators, S&P above the 50-day moving average. We're at nosebleeds right now. Look at this. Another sign saying, wait a minute, we're way overboard here. And different indicators will tell you we're overboard when you're not overboard. Again, that's momentum, but stocks above the 50. Anytime you get up in these areas, you will have a market that will pull back. Now, does it pull back? Does it have a sell-off, a big sell-off? Nobody really knows, obviously, until the pullback really starts to happen. Okay, VIX. Now, this is, I mentioned the VIX here. We had this bullish fallen wedge. Here's the Bollinger Bands, and now we're getting outside the band. Now, a nice little buy signal in the VIX would be a pop down and then back into the band, which will create a buy signal for the VIX, a sell signal for the markets. Stochastics, again, here, way sold. Okay, and look what's happening. Obviously, it's an inverse. RSI down below 30 here, so this is something I'm going to be continuing to watch, and even intraday I like looking at to give you an idea of what's going on in the market. So what we have here is total complacency, and here's another one I want to show you. Equity put call, total complacency here. Look at the put call ratio, lower high, lower high, lower high, lower high. Market's fueling up, 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 up. So as you can see here, we've rallied up, and an indicator again being oversold, and now we're starting to hook up a little bit, but total complacency. So this market is basically driven on complacency, right? Not any kind of hard economic data, steady manufacturing numbers. That's not happening. So it's just basically what the Fed is anticipating to do. These market participants are buying on what the Fed may do down the road. So to me, that's not a healthy market at all. And being a market at where these lofty levels are, 1390, 1380 right now, that's something that's a big concern to me without any type of pullback. So, in that note, let's go right into the bonds. I wanted to show you bonds. Here is a daily chart of the 30-year bond index. Does it look like that people are running out of bonds and into equities? Absolutely not. That's why momentum is waning. They're looking for safety. So here we have the bond market really not telling us, saying, hey, wait a minute, equity is a great time to take on some more risk. No, it's not. So that's something that's really discouraging for the bulls. Here's the weekly chart, and if that doesn't tell you anything, we have an 8 MA, and that's just following, hugging that trend line. So it doesn't look like anytime soon that the bond market is looking is going to start selling off. Now, if it does sell off, then we're going to have a good the bond market's going to go right into equities. The money's going to flow right back into equities and then surge this market higher. Look at the TNX, which is the 10-year yield. And I mentioned this about a week ago or so. If you go back to past history, we have double top, the yield sold off. Again, double top, and then look what happened. Equity markets finally caught up, and then we had that major sell-off that crashed down in 2009. And look what's happening now. Markets are rallying again, back up to these lofty levels, and look what's happening. Yields are actually just getting destroyed. Bonds higher, yields lower. When the yields get lower, right, that means that the bond market is people are buying bonds. So if they're buying bonds and they're not buying equities, well, this market shouldn't be at this area. So this is a concern to me. Just want to make sure, keep that note. That does not mean we go out and sell the market today. We trade what we see. We trade what price action and volume are telling us. So that's just, just wanted to make certain of that. That doesn't mean you can't put on hedges if you're long, if you're looking to swing trade. All right, dollar, U.S. dollar, almighty king. In this range here, nice little orderly pullback. So the dollar, I don't think the dollar is dead by any stretch of the means. We do have the commodity sector, CRB index, the DBA, the agricultural. As you know, I talked about grains before. Crude oil, all rallied higher based on a weaker dollar for this last week. That does not mean that this can't burst out and go higher. Now, I did mention we had this bull flag here. We rallied up to resistance, double top, and now we have another small bull flag right in this area. So this is something that I want you to be aware of, that once this dollar starts to move again, you're going to see money coming out of equities, and that's for certain. Now, I wanted to talk about the S&P 500 for a little bit. See, okay, where are we, Mark, right? We are overbought in our indicators, right? Stochastic not really that overboard, starting to get up in these overbought levels. But if you noticed how we had a nice little move we have, as we're moving higher here, right, off of this initial thrust higher, right, we're moving higher. Stochastics actually moved up higher, had a little dip lower, back up to this area. Now look what's happening. We're back here. Look at where the stochastics are. They're not even back at these overbought levels. They can't even make it back up there. So momentum is definitely waning. And what I did was I put a Fibonacci retracement from the top here to the bottom, all right? And where are we? We blew through the 61.8% retracement. Technically speaking, anytime you get these diagonal patterns, they love the 61.8, 76.4%. And then they start looking to retrace. Now, we're almost there already, right? And I mentioned about some volume profiles, do some volume analysis. These are volume bars in the back. If the market does tend to get up to this area, which would be the top of this rising wedge, and get to 76.6, 76.4% retracement, if it can't hold here, then I see certainly that the market's going to roll back over and possibly break this lower trend line of the rising wedge, and then probably look to get to at least a 200-day moving average, at least back to that 1300, 1260 area. That's going to be the target if this does decide to break. Now, can it break higher? Absolutely. And we don't want to assume that the market is just going to sell off right away, because there are a lot of shorts that are still up in this area, and usually a good rule of thumb for a good trader is where to find the shorts on the charts. Well, if we get above this area here, basically right where we are now, if we get above it, look at the volume bars here, this volume profile, very, very thin. So that means that my guess is that if we do break above here, you're going to have shorts getting squeezed because they're going to get their stops elected, and then this market's going to fuel at least to the upside. Now, I have two trend lines here, these dotted trend lines. One, of course, we're above it. Now, the second one, we're right here, okay? This is coming off the two tops here. Now we have a higher high. We have a high here, and then we have a lower high here. Small, but still a lower high from here. Now we want to see if we do get this area here, we make another lower high. That's also telling you that momentum is waning. Okay, so really something I want you to keep an eye on, guys. Make a copy of the chart. This is something to be watching, even if you're a long-term investor. Okay, so I mentioned that inverted head and shoulders way back in June, and look what's happening. We are literally at our target again. We hit it once already, well, close to it, and then we actually roll back down. But now we're basically at our target. So 1390 is going to be an inflection point for this market if we're going to move higher. If it does fail, we get a reversal candle, takes out that low, then that would give you a sell signal to start entering short. Remember, nothing just goes straight down. It will break, back test, and then look to go lower again. And that's going to give you that real true indicator that we are headed lower. SPY, excuse me, the spiders, I like looking at that with the volume. Volume was better, absolutely better, but nothing great, okay? And then look what we have. We just put that little doji indecision candle here. So, and again, the indecision candle doesn't happen unless we break out yesterday's low. That would give you confirmation. So right now, all it is just an indecision. It could go either way here. And this is the concerning part, transportation sector. Leader of all the indices. And as I put these arrows here, I wanted to show you we couldn't break out. We did break out, but no follow-through. Look at this. We're stuck here now in this range. All right, very concerning to me. If you are a bull, I would be concerned. IWM's Russell, a good gauge of risk, right? People investing in the Russell 2000, risk-on sentiment, good gauge of it. And look what's happened here. We actually came right back down again. So this is not healthy. This is not what you want to see. You want to see the Russell, technology, the bank sector go into play here. Okay. Last but not least, SMHs. I did say watch the earnings coming out of the semis. They've been decimated. Sure enough, we did get that beautiful big pop up. Now we really didn't get any follow through. We did a little bit, but we actually closed at the low. So just. Not that I don't think there's anything disheartening about it, but I'd like to see a little bit of a pullback here, right up to this area, and then I look to buy some of these semis. Again, only if the market's healthy. Okay. Last chart, Q's to show you. We had a nice little run up, big cap tech right up in this area. So nice volume. That's not a bad looking chart here. One more, guys. I'll let you go. And the diamond, same thing. Nice indecision candle with the spider, with the S&P. All right, guys, that's it. Be on your toes. Today's going to be relatively light. It's a Friday in the summer, so I wouldn't really read too much into it for today. Next week will be interesting, though. We are at an inflection point, so I definitely be using your stops. Tighten your stops up if you swing trading. Have a great weekend, and I'll talk to you on Monday. Take care. Good morning, everybody. Welcome to the Trading Market Technicals morning call video for Thursday, July 19th. Had a nice up day yesterday. Again, low volume, but basically caused by good housing starts. We had some good econ data. And we had a nice little rally in tech. And I mentioned a couple days back, I said Intel's going to report. Watch how Intel trades. And if the bias is to the upside, regardless of how they report, right? It's how the traders and investors react to those numbers. And sure enough, they sold them down a little bit in the morning, and then they rallied, and then brought every other tech stock, semiconductors, up for the day. And we had a couple of good ideas, some trade ideas yesterday. Broadcom being one of them. The other day before had gotten decimated, but again, these stocks can only go down or up for so long before they reverse, and that's what happened yesterday. And on top of that, breaking out of yesterday, we had the day before, we did break out of this new range. As you remember, we've been in this range for 2 weeks. So we broke out of it, which created new buying opportunity, new inflows of cash, and that actually pushed markets higher and broke out of this base. Now, where do we go from here? Well, we are not overbought as of yet, as generally in the market's concerned. I did say that, although there are some major red flags and signs of cracks in the armor, we can still trend higher and get up to that 1390, 1400 in that inverted head and shoulders, which I'm going to show you as we go. But there are no sell signals as of yet, so even though they're cracks, that doesn't mean that we can't go higher. So we really need to understand that. We don't want to just plain blindly just shorting the market. That's not what we do. We want to stick with the trends, but knowingly that we have some issues in the market, we want to make sure that we're always cognizant of what's going on, and that's the main issue. So if the market is healthy, and I've been stating, be very, very careful here. If the market was healthy, we should have more money flows into more of the speculative groups, but we don't, right? We mentioned that before. We do have energy and financials. They have improved, but money is still flowing into consumer staples, healthcare, and the REITs, which I showed you yesterday, and of course bonds. So that's something that if the money was really there, pushing into these speculative sectors, we wouldn't see that. We'd see a total inverse, and that's not what we're seeing. Okay, so basically the bond market is not buying the rally. That's really what it comes down to, right? So a lot of people are complacent getting low yields for trade-off for a safe haven asset. So that's something that's really concerning to me as a technician, and we don't want to see that. We want to see clearly the opposite. But we'll get into the charts, and let's get into our indicators like we always do. And I wanted to show you the BCM bar chart market momentum index. So we're right here now, right? So that means that we're not overbought yet, right? So we can actually go much higher and probably hit that 1390, 1400. We're only about 20-something S&P points away, and I'm going to show you that to you in the chart. But so we're not really overbought as of yet. So I could see this market go higher, as well as a little adding tribute to options expiration. General rule of thumb: options expiration usually has a positive bias to the week. Okay, you do have a couple of down days in between that make up the week. However, we do have a lot of skewed trades, a lot of large hedge funds, and they like to write calls and puts, and what happens is they try to protect that position to collect the premium. So the market could be a little skewed. Now what happens usually is that if the market does continue to rally today into tomorrow, you usually get some sort of reversal sometime next week. Now how deep and how big, nobody really knows, but just keep that in mind. All right, so we have the bar chart momentum index, as you can see here. We're not overbought. I don't have it today because I showed you yesterday, but the NYMO really didn't change much, maybe plus 20 points. Again, not really showing overbought readings. But I want to show you the VIX too as well. And as you can see, we do have a bullish fallen wedge here, okay? Or if you want to call it a nice bull flagpole up in here and then a wedge. So we're getting right down below here. Another move lower to break below the Bollinger Band will issue a buy signal in the VIX and would actually issue a sell signal in the market. But we haven't gotten that yet, as you can see here. So as you see over here, we closed outside the band, and what happened? VIX rallied and S&P sold off. So that's something here to keep note of. But right now, no sell signal. Okay, Shanghai did pretty well, but again, I don't see this. To me, doesn't say, wow, this is some big rally. Every day, if you look at the sell-offs, they're larger than the buys, than the accumulation days. So the distribution days large. Look at the accumulation, very very small. Again, this is not telling me anything really good. Copper again, just to show you that copper did not rally again for the second day. Not good. These are all little things that are cracks in the armor. That does not mean that we can't get long for the day, But if you are swing trading, you got to be very careful here. Maybe I would be, as of right now, I would, if I was holding position, which I'm not, I would be initiating some hedges just to ride out the storm if in fact it did come. Okay, let's take a look at the bonds. Oh, actually, before that, let me just show you the stocks above the 50-day moving average. Back up to nosebleed. So this is one that's really overbought here. All right. Again, just a flag concern. Once we get our trigger and we get our close below yesterday's low or taking out the previous day's low, then I could say you can literally start looking to short the market here. All right. Now, I want to show you bonds, a 30-year bond. And if the market really rallied for the last 2 days, this thing really barely budged. So again, another crack in the armor. But I want to show you now the dollar, and I'm bringing you a 3-year picture, a 3-year view of the dollar. We are in this consolidation area here, and if you remember, we had that bull flag, and then we rallied, and we broke out, and then we fell back in again. So the dollar is consolidating and actually flagging back in. Okay, to be expected off a big move. However, and what I wanted to show you is that if this dollar does break above this area here, I think you're going to get a run of the highs. And if that happens, look what happened here in the S&P. This is the dollar S&P index. Look at the S&P literally just get decimated. And I think that could happen between now and the fall. Okay, at least a real scary sell-off, and then, of course, a rally into the new year. But this is something that may not happen. Maybe they'll roll back into here and then bounce around and chop around for the rest of the year. But this is something that we need to keep an eye on the dollar. Okay, now the dollar has been getting weaker because we have risk-correlated assets that they're buying, so they're selling the dollar and they're selling all of the other high yields. However, some of the other high-yielding currencies are actually rallying. So something, it's again a mixed bag. But I want everybody to take note of that, okay? Let's take a look at the regular U.S. dollar here, a 1-year chart, and this is what I was showing you. We're in this range, and we're just flagging again above the 20, above the 50, and above the 200. So very positive still. This is just normal and healthy reading coming off of an overbought reading, okay? Now, one thing I want to show you is one more thing is if I have here USB. Okay, yes, I showed you the USB. Okay, so let's go into the charts. Let's go into the indexes, and I want to show you specifically. Spiders daily, like to show the volume here. Lighter volume than the previous day, although we did get high. We did take out the previous day highs, which is also a good positive. We're above the 20, 50, and 200, and we're in this little wedge or rising channel, if you will. You could even look at this as one big bear flag here, big flag pole, and a flag pattern here. So a test up to this area would not be out. We did fill the gap. Okay, if you can look at this area here, we took out yesterday's high. So everything's turning positive. So today, tomorrow, I wouldn't doubt if we were actually trading higher. Again, low volume, concerning to me, but we are up in our MACD starting to curl here. My guess, we just kind of run up a little bit into the end of the week. Now, Spider 60-minute chart. We're back up to this area. Inverted head and shoulders, as we talked about back here, back a couple of weeks back. And now we're just trending higher. So that 138, 139, 1390 in the S&P cash really would be the target. And this is the S&P cash, what I want to show you. I brought the chart in a little bit, and I wanted to show you a little bit of volume profiles, which is really a good indicator on it. Works more on a daily chart. Really doesn't work well on a 5, 15, or 30. Maybe the 60-minute because it's a little longer term out. But I wanted to show you is that we have these little volume pockets here. And once we get into this area here and that S&P broke that neckline, we really don't have much here. As you can see how the S&P just trailed up all the way up from February, January, and low volume all the way in here. We did have a little bit of selling, little volume in this area here. But so here's what happens. We're in this rising wedge. We're back up here at resistance now. Now a breakout of this resistance and hold and consolidate for a couple of days. We'll probably get the run to the 1400. 1415, 1420 area, and at least a retest of the highs up in here, okay? And we're really not that far away. As you can see, the S&Ps have been tacking on 20, 30 points a day. That doesn't mean that it can't happen, okay? But, and again, if you can look at our stochastics, we're really not overboard here. But one thing I want to show you why I say that this is possible to run up here before we sell off is we clear this area here, right, 1382. we really have no volume. Okay, look at the volume. Volume actually dissipating here. So this is very positive, at least in the short term, that if we do break above and close, we have a volume profiles are showing us there's no volume. So we have a thin zone up in this area where we can actually really run up here, at least for the next week or so, or maybe a week we consolidate and then run higher one more time. So something to consider. Again, there's enough for the bulls and the bears, but now we got to wait for the market. Now here's concerning to me: the transportation sector. Can't have a rally without the transports, tech, and of course the banks, the financials. Just can't have it. It's not going to rally. They'll rally, but they're not going to give it a full-fledged, trend change up higher and into new highs. Very concerning to me here. We can't. Market rallied yesterday, led by the S&P, not by tech. Well, actually, tech did well yesterday, but in general, transportations didn't do well, and the semis the small caps didn't do well as again. So concerning. Another concerning area. Here's the Russell. We broke out, but nothing. You can see here, nothing really that says, wow, what a great day for the small caps. Not at all. All right. So those are another two flags that I like to point out. Now the rest here, I want to show you the SMH is a semiconductor ETF. Big day yesterday. Big day yesterday. And I mentioned watch the semis. Now we had a big day consolidation. I would not. Well, we've actually really had a bad. As you can see, the sector got decimated the last 7 to 10 trading days. I'd like to see a pullback in this area here, right up in this 30-45 area, 50% of this candle, and then I would say look to enter long. Look for a beaten down semiconductor, and then look to enter long. One comes to mind, AMD. They report after the close today. Now they guided lower. If they are positive and guide higher, or if they come out with better earnings, that stock's going to explode to the upside. So that's something that I want you to take a look at, as well as I'll be looking at for tomorrow's trade. Okay, so that's the SMHs. Qs, regular tech, did well, much better. At least we have inline volume. And I want to show you the last but not least is the diamonds, which is the Dow Jones Industrial Average. Okay, all right, guys, that's really about it. But again, a lot of pluses and minuses. I would say if you're swinging short, I would tell you to put on some hedges. If you're just regular day trading, stick with the trend until the trend changes. Okay, have a great day, and we'll see you tomorrow. Take care.